attorney Laura Anthony, founding partner of Anthony LG, a corporate securities and business transactions law firm. Today is the first in a Lawcast series talking about changes in capital markets related to low-price securities. There is a strange dichotomy building in the capital markets and what some are calling a clearing firm crises. At the same time that the world of penny stocks and low-price securities is on shaky ground with regulators and market participants, the U.S. is trying to regenerate the IPO marketplace, and a whole world of cryptocurrency investments and global trading continues to flourish. However, the IPO market cannot flourish for small companies if stockholders cannot clear their securities and sell into a secondary marketplace. Recently, penny stocks have experienced a 1-2 punch that leaves me and many of my colleagues wondering how the marketplace will respond and evolve. Furthermore, as the inevitable birth of securities tokens and an actual licensed operational securities token exchange looms on the horizon, it is clear that we are at the precipice of experiencing fundamental changes in the capital markets. Penny stocks and low-price securities have always been considered speculative and risky investments with the potential for large swings in value, thus enticing investors with an appetite for risk. As a result of the risk associated with the penny stock trading, Congress enacted the Securities Enforcement Remedies and Penny Stock Reform Act of 1990, the Penny Stock Act, requiring the SEC to enact rules requiring brokers or dealers to provide disclosures to customers affecting trades in penny stocks. The rules prohibit broker-dealers from effecting transactions in penny stocks unless they comply with certain stringent rules, including providing a Schedule 15G risk disclosure document to customers. Since enactment of the Penny Stock Act, broker-dealers do not recommend or solicit transactions in penny stocks, but have, at least until recently, effectuated client-requested transactions. A penny stock is defined in Exchange Act Rule 3A51-1. Like many SEC rules, the penny stock rule begins by including all equity securities and then carves out exemptions. The rule defines a penny stock as any equity security other than 1. An NMS National Market System stock that is a reported security and that is registered on a national securities exchange that is grandfathered in because it has been in continuous operation since prior to April 20th, 1992, or is quoted on either a national securities exchange or automated quotation system that has certain quantitative initial listing standards and continued listing standards that are reasonably related to the initial listing standards. The listing standards must meet or exceed the following criteria. The issuer must have $5 million of stockholders' equity, market value of listed securities of $50 million for 90 consecutive days prior to applying, or net income of $750,000, excluding extraordinary or non-recurring items in the most recently completed fiscal year, or in 2 of the last 3 most recently completed fiscal years. The issuer must have an operating history of at least 1 year or a market value of listed securities of $50 million. The issuer's stock must have a minimum bid price of $4 per share, and there shall be at least 300 round lot holders of common stock, and there must be at least 1 million publicly held shares with a market value of at least $5 million. The next exemption of a security from the penny stock rule is a security issued by an investment company registered under the Investment Company Act of 1940. Is a put or call option issued by the Options Clearing Corporation. Has an inside bid quotation of $5, and the rule requires that the price be net of broker or dealer commissions, markups, or markdowns. Is registered or approved for registration upon notice of issuance on a national securities exchange that makes price and volume transaction reports available subject to restrictions provided in the rule. Is a securities future product listed on a national securities exchange or an automated quotation system sponsored by a registered National Securities Association, or whose issuer has net tangible assets as calculated in accordance with the rule in excess of $2 million if the issuer has been in continuous operation for at least 3 years, or $5 million if the issuer has been in continuous operation for less than 3 years, or average revenue as calculated in accordance with the rule of at least $6 million for the last 3 years. I'm securities attorney Laura Anthony, founding partner of Anthony LG and producer of Lawcast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.